we're going to be talking about locator cash flow. The first thing I want to do is just review what the goal is. I know you've read the business dilemma in your packet, but the goal here in purple is to decipher why the results don't match the projections, why the checkbook doesn't build as planned, and then offer the entrepreneur any insight about what you know or can predict or can understand from the data. What is the setting here? Larry, your client, is upset. Why? Because he had different expectations than what the checkbook is showing. What were his expectations? You have the initial budget, which was shared with him. It looks like his initial expectations was that he was going to make $26,000 a month. And then when you go to the checkbook over here, you see that at the end of January, there was $15,000 in the checkbook, and then in February, there was $400 in the checkbook. That is not at all what he thought. He is thinking there's going to be $26,000 in January and $26,000 in February, and so he is wigged out. He is deeply concerned that he's been misled by his accounting experts and that none of these things that they've been telling him could happen are happening. And so he doesn't know whether to pull out or continue or what. He's confused, he's upset, he doesn't understand. And so your job is to come in and immediately make sense of this and tell him, is this not a viable business? Is everything fine? It's temporary, or is this going to drag on for a long time? And help him to make sense of this. So that's our goal, and it's a good idea to check back with that from time to time, make sure that you keep that goal in mind. The project gives you certain steps to complete, and those are not necessarily the goal of the project to go through those certain steps, but those certain steps will guide you to helping you to address this question. So just gives you some places to get started. So there's not that many transactions in the checkbook. They give you a chart of accounts, so you can certainly log each of these transactions in the accounting equation if you like, and book them to these various accounts, and you can create your own transaction list and make sense of it from a double entry point of view. That's one possible thing. You can certainly do that. Here's a list of all the sales in January, and it looks like they sold 202 locators. It looks like the sales price is exactly the same for all of them. That will be simple. That the price for the annual subscription was the same, $120 for each of the customers. That's will make things simple for you. Then on the input sheet, you have the assumptions that were used to make this initial budget that gave Larry his expectations. And then you have the actual information. So the actual sales is on that sales tab. You have the checkbook for the various expenses that went on. And then these were true, that the dealer commission was exactly as planned, and that what they paid for these items were exactly as planned. The warranty is still expected to be that, and the interest rate is still expected to be that. All right, so let's start. There's two pieces to this. One is, what are the recurring profits that are reasonable for Larry to expect? The second piece is, what is the cash flow that is reasonable for Larry to expect? And those are not identical. So let's start and see whether his profit budget was reasonable. And so what I'm going to do is go ahead and just put January's actual in here. And see, how close we are to what it is that he was initially told. All right, so how many locators did you sell? Notice that I'm pointing at the data rather than keying anything in. I'm not hard coding anything. So he had 202 sales times, and the sales price for all of them was the 230. But I think I'm going to point back to the input sheet rather than that 230, although you could point to both places. Okay, so the monitoring service is a monthly subscription, and so each of those 202 should have paid the 120, and 1 month's worth would have been divided by 12. So from the accrual basis, those are the revenues that January earned, or what we think they earned. All right, cost of goods sold. So what are these things, units that they're selling cost? So the housing, cell phone, and battery cost $55 a piece. There's some epoxy costs in addition to that. They order 1,000 at a time. That's a minimum order from their vendor. There's some operating costs. Some are per unit, like the cell phone service, and some are per month. So those are fixed and not varying based on the units. There's also some selling costs. There's a variable selling cost, $9 per locator, and also the commission. But for cost of goods sold, we need that $55 for the units that were sold. So plus each of the units, they cost us $55 a piece. We can go to the checkbook, by the way, and just verify that the $55 we should do that. Let's see, where did they buy their locators? Here we go. Here's where they bought 1,000 locators, paid $55,000, so $55 was the actual cost per unit. No difference between the initial budget. All right, so now we can go back to grabbing how many did you sell to use the cost. All right, epoxy. So the actual cost of the epoxy, let's go to the checkbook. Let's just review the checkbook for just a minute. Larry made an additional loan that wasn't initially anticipated in the budget. Of course, that wouldn't show up on an income statement, but the interest on it would. We've got their rent for the month. Let's see, occupancy costs. We can go ahead and put that in. That is what it was. We'll put that in as a positive number. Okay. Let's see, what's next on the checkbook here? We've got 112, some supplies, office supplies. There were no office supplies in the budget. I want to do minus because the checkbook has it as a minus, but I'm not doing expenses as minuses, although you could. All right, and then we have printers. They've got some brochures. In the budget, that's put it in with that. All right, so we have some things that weren't budgeted. Okay. Then we have payroll. And payroll, when you read the story, you realize that they have somebody that's in charge of customer service and somebody that's in charge of the website. So this is payroll for both. Let's go see how it was budgeted. So the website and the customer support, the payroll is for both of those numbers. We don't have to split that out because they didn't give us that. So let's combine the budget to website and customer support. Make that one line in the budget. So I just combined those two. And now I can put what they actually paid for the month of January in there so that we can make a proper comparison. All right, what else is in this checkbook here? So that takes care of January. Then in February, we have some revenue coming in from dealers. This is net of that 15% commission. So you would want to just verify that that's what they got to put the dealer commission in here. So the commission should have been 15% of the hardware. They don't pay a commission on the subscription. So let's see here. Let's do a little test to see if that equals what the deposit was. Was the deposit $39,491? It was. And 10. Yes. Good. Okay, so our budget, our January actual matches the checkbook, those two numbers net to what was deposited. All right. What else we got? We have some deposits for service fee. Okay, so we have a budget of, well, that's the monthly accrual for the service. But we didn't get the full annual amount, did we? So how many units is that? Only 51 of the 202 units that we sold actually paid for the subscription. So that's going to be a big difference between accrual and cash flow, because we've accrued in for 1 month subscription on all 120, and maybe those will be slow to pay, maybe those will come in March, who knows. That's an assumption we'll have to wrestle with in this project. Okay, so there's another loan from Larry. Look at that. So no wonder he's so upset. Not only is he not making the profit, but he's had to put in another $30,000 into the business just to keep it from being overdrawn in January and February. So not only is he not seeing $26,000 in his checking account for 2 months in a row, he's had to put 30 in. Well, no wonder he's hot under the collar. All right, so let's see. Here's our occupancy for February. There's where we bought the goodies. Here is where they paid for some shipping. So this looks like January's. Let's see, January 25. So that was January's epoxy, packing, and shipping. Let's see, where is packing and shipping and epoxy? Okay, so let's combine those since we don't know how to split that out of the checkbook. So let's see here, packing, shipping, and epoxy. All right, and then, so we want to add this. Payroll those. Okay, so then got epoxy now included with the packing and shipping, and now we can compare it. January's actual, which was paid in February. All right. Depreciation, there will be no change in depreciation, so we can just point to the budget. Warranty costs are 5% of sales of the hardware. So you go up to here times your 5%. Notice I'm not hard coding. Did I hard code that commission? I did. You really have to fix that. Alright, so okay. I'm going to fix the formatting here in a second. So we have a formula here. I really like the formula, let's face it. So let's add up all the expenses. And then let's go back in here and plus the two revenues minus the sum of all the expenses. And I can take out this line and all right. And cell phone service. Where do we pay for cell phone service? Here we go. Cell phone service for 202. Let's see if it was what was planned. Exactly budget. Okay, so you can point to my assumption sheet. Plus the 202 times 8. All right, so let's see, from an accrual basis, based on the data that they gave us, we'll have to do interest here in a minute. Let's combine all those babies. Ooh, big difference there in operating profit. Now, of course, this is still nothing like the checkbook. He might even be okay with $14,000 in the checkbook instead of having to put 30 in. But we clearly are not. But they actually have something to report there. That's not dollars. So like that. All right. Interest expense. So that interest expense was based on paying Larry for these items here that he bought, but now he's also put in additional loans. So we'll put that in our budget. So plus the original interest plus the loan in January times interest rate, which is 8%. Okay, so that's your accrual. Oh, we just need 1 month of it. There we go. Okay. And that formula still looks good. I'll just drag it over. Okay, so one of the first things we need to do is to indicate to Larry that 26,000 is not a realistic budget if he's going to be selling 202 versus 300. But this doesn't really solve the cash issue, because clearly he's not getting 14,000 in January and 14,000 in February, so where's the cash? And that's a serious thing that we now have to solve that. And so I'm going to start a new video for that so that this one doesn't get too long. So here's the profit piece, get you started. Now we'll do the cash in the next one.